At the year end, Janice receives 20 million. At the year end, Janice receives 20 million in return for issuing a financial instrument. Janice is issuing a financial instrument. If it is shares, gearing goes down. If it is shares, there's no expense in the P&L. If it is debt, then gearing goes up. If it is debt, then profits go down because you've got a finance cost. So when we issue a financial instrument, it's really important that we classify it correctly as to whether it's debt or equity. Because if it is equity, the garden is rosy. Everything is beautiful. If we classify an instrument as equity, it looks like we've got less risk, less gearing, cheaper and easier to borrow money, and there is no downside on profit. If you give your equity money, that's a dividend, that doesn't affect your profit. If you classify it as debt, it's ugly. If you classify it as debt, your gearing goes up. So it is more difficult, it is more expensive to borrow money because you've got a higher gearing. If you've got debt, debt needs to be serviced. Debt has a finance cost. Debt has an expense attached to it. So from a creative accounting point of view, somebody will always want to argue that it's equity, but we've got to account for it properly, and we don't know whether it's debt or equity. I haven't really read the question. So this is just a little bit of an aside, yeah, as a little bit of warm-up, because this is the area that we're looking at. A financial instrument creates a financial asset for one party and a liability or equity instrument for another. The investor has given us 20 million, they have an asset. They either hold shares in us or they've lent us money, either way it's an asset. In our books, we've got to make a distinction between debt and equity. In our books, we've got to decide whether it's an ownership interest, loosely defined, or whether it's a liability, which is a present obligation. Yeah, to present obligation as a result of a past transactions or events, the settlement of which will result in an outflow of economic benefit. This is what we should do. A contract is where we must issue a fixed number of shares in 2 years' time, but the number of shares to be issued will be determined on the price of the shares. If the price goes up, the number of shares we issue will go down. So we have a variable number of shares. Where the contract is settled. Where the contract is settled. By either the issue of a variable number of shares, or for a variable consideration. The instrument is debt. Where the contract is to be settled either by the issue of a variable number of shares or for a variable consideration, the instrument is debt. This instrument is debt. This instrument is debt. This instrument is a liability. Only when it is for a fixed number of shares and for a fixed consideration is it equity. So you have to be fixed and fixed. If you are fixed and fixed, it is equity. So you only have an equity when the contract is to be settled for the issue of our own shares. If it is fixed number of shares, fixed consideration, then it is equity. I'm banging my head against the brick wall. This is a rule. This is a rule. I think the framework gives us a different answer. I think the framework gives us a different answer. The framework, perhaps we could do it another way. We could do it another way. We have said in this example that where Janice is to issue a number of shares in settlement of the financial instrument, we've said it is debt. But the definition of a liability is a transfer of economic benefits. To issue shares is surely not a transfer of economic benefits. You're not paying out money, you're issuing shares. A liability is settled by a transfer of economic benefits. To issue shares is not a transfer of economic benefits. This is not debt. Further framework. Further framework. This is not debt. Further frame. Janice, there will be a question in question number 4, which is based around an article, based around a current issue. One of the articles, one of the current issues revolves around the framework, and I quite like this question because it pulls together things around deferred tax and things around leases and things around financial instruments, which themselves could actually be examined anywhere else. It's a very theoretical question, and that is often the case in question number 4. You have some articles to read, and those articles may, I cannot guarantee, but may form the basis of a question that would be appearing in question number 4. It's perfectly possible that you could look at question number 4 and sort of recognise it and like it and have a go at it. It's Also perfectly possible, you could look at question number 4 and think, what planet is the examiner on? So, you know, you would then have an instant decision that you're doing the 2 accounting standard questions. Just before I do the tips, I did put a red asterisk against a couple of numbers in the cash flow, because those 2 numbers were wrong. So actually, I was getting 33 out of 35. Yeah. The right answer is at the back. It's quite complicated to explain what those adjustments are, but one was to do with the tax rate on the associate and the taxation charge in the associate. The taxation charge in the P&L was wrong because it included something to do with the associate, and the other was the fact that the liability to pay the PPE creditor was included in trade creditors. But how you're supposed to get either of those facts by just looking at the question, I don't really know, and so sometimes I do bother to explain it, and sometimes I do, I'm afraid, what I'm doing now, which is, let it go, don't worry about it. Let's have a look at the tips.